go. We've opened up now. Once again, I'll just give it a moment for the participants to join. All right, conscious of time and giving Owen as much time as possible to hit the mark on the content, I'll launch into it. Good afternoon, everybody. My name's Stephen Connors, CEO of the FSAA, and welcome to our, I think this is our second last webinar of this year, but our third on IFRS 17 with Owen Tong. Owen's back again today to cover some mechanics of IFRS 17. So yeah, we really appreciate him taking the time to not only prepare this presentation, but being with us again today. The previous two this year have been absolutely well received, so it's fantastic to have the opportunity to have him back. Just a little bit about Owen before we hand over to him. He specializes in this space in interpreting the application and the interpretation application of IFRS 17. He's the founder and managing director of Real Value Consulting. He's built a number of PAA eligibility models from scratch, projecting, IFRS 17 liabilities, but also financial accounts. And he's assisting a number of companies in this space, QBE, Westpac, Deloitte, AMP, Hanover, just to name a few on their implementation journey. The webinar's going to take up the bulk of the hour, but there'll be a short window for some Q&A at the end. So if you have any questions, please feel free to pop them in the Q&A, and we'll try to get to as many as possible if we can. So without further ado, I'll hand over to you, Owen, and join you back at the end for the Q&A. Thank you again.
Cool. Thanks, Stephen. I'll just share my screen and get stuck straight into it. So let me share this screen. All right. So let me just kind of like give you guys a snapshot of what I'll be talking about today. So I've already done 2 webinars with the FSAA this year, and this will be the third one. And the first webinar I really touched on, I guess, groupings and levels of aggregation. The second webinar looked at the core components and understanding the definitions of what each of them were, and that included the components of the general measurement model as well. And so what this webinar is intended to do is to go through some mathematics of that, because what better way to explore the ins and outs than to just look at some numerical examples. And so what I'll do in this webinar is it'll first start off with just a brief overview of just the measurement methods, the general measurement method and the premium allocation approach. And then the bulk of the webinar will be covering the mechanics of the general measurement model through 2 examples. And the 2 same examples are going to be used for the premium allocation approach as well, just so that you guys can see the discrepancies and the logic that's contained within both of these methods. Then these are going to be brought together when I talk about PAA eligibility. This is very topical, and I wanted to just give you guys some ideas of, I guess, what you guys might need to look at when determining PAA eligibility, and finally concluding with what's next. So all of these concepts that I'm going to be going through for this webinar are going to be explained from the perspective of a general insurance company and also a direct insurer. This kind of like contains the webinar to one perspective, just so that we can understand a specific snapshot, which is going to be the majority of, I guess, of the understanding anyway. The following detail components won't be covered in detail because it's, as you guys have known on your IFRS 17 journey, there's lots of interrelated components of IFRS 17. And so I won't be covering disclosures or onerous contracts or risk adjustments or liability for incurred claims in detail. I'll mention these, but each one of these can have a kind of like a separate webinar all to itself. And as you know, if we try and include all of this in one webinar, it can get confusing very, very quickly. So any information provided in this webinar, just for disclosure purposes, it's only intended for entertainment purposes. And it doesn't take into account any of your personal, individual, or company objectives. And so before acting on any of this information, please consider the interpretations that I've kind of given. This is only my company's interpretation. And if you really would like to take this a little bit further and think about anything in specific, you can reach out to a real value consultant that specializes in IFRS 17 to assist what you guys are doing in your company. So let's get stuck into it. Let's look at the measurement overview. So throughout these slides, similar to the webinar number 2, there will be a series of, I guess, standard paragraphs that I'm going to pull in. And the main reason to pull these in is because I want you guys to see exactly where this appears in the standard. And I know many of you may not have even opened the standard and looked through the paragraphs because it is very dense and it is a hard read. It's definitely not an easy read. Over 100 pages plus appendices and basis of conclusions attached to it. So I just want to pull out the relevant parts, and we won't be going through these parts in detail, but sometimes I might just highlight a few components. So before diving into the general measurement model and the premium allocation approach, the key understanding is that, and this was talked about in previous webinars, that if you have an insurance contract that an insurance company issues, it covers, let's just pretend it covers 24 months worth of risk. And there's a liability associated with it. And from an IFRS 17 standpoint, the whole purpose of the, I guess, the insurance standard is to try to quantify that liability. But when you're midway through an insurance coverage, you still have, so you have two components when you're midway through an insurance coverage. You have a period of time, so going back to that 24-month insurance cover example, if you're halfway through the insurance coverage, you would have had 12 months of insurance cover that has elapsed. Now, claims might have occurred during that period, and maybe they haven't been reported, but you have a liability attached to that period. And at the same time, you look forward, and in the future, you know that there will still be 12 months worth of cover left. So the entire liability, or the total insurance liability, is split into those two components. One, when looking into the future, is referred to as the liability for remaining coverage, and one in the past is referred to as the liability for incurred claims. And in the standard paragraphs, you can see that it's very obvious that the paragraph says that it's an obligation for the liability for remaining coverage that relates to the unexpired portion of insurance coverage. And for the liability for incurred claims, it refers to the events that have already occurred, but for which claims haven't been reported, or maybe you haven't completely paid them out yet. So the liability relates to the premium side and also the claim side as well. It's basically any cash flows that you're still owing on a net basis. And so when we're looking at these liabilities, we want to be able to quantify them, as I was saying, and there are really generally two measurement methods to quantify them. And so one of the measurement methods is called the general measurement model, and the other measurement method is called the premium allocation approach. And these two measurement models are kind of like brought up in the market over and over again, and hence, which is why I want to take you guys through the ins and outs of both of these. Just before I continue on to the next slide, I just want to draw a similarity in the general insurance space, and this may not translate into the life insurance space or the health insurance space. And the similarity is that when we look at the future claims for general insurers, you can think of this as more similar to the premiums liabilities, because we are also trying to estimate the claims associated with the unexpired portion. Now, it's not a one-for-one link, because there are other components that premium liabilities consider that aren't in the liability for remaining coverage, but it's very similar in construct. And the liability for incurred claims, it relates to, I guess, the claims that have already occurred, but for which your obligations are still outstanding. And so it relates to the outstanding claims liabilities, which is a current view or current terminology under AASB 1023 under general insurance. So if we go on to the slide here, The main, I guess, summary that I just want to take you guys through before we jump into the illustrative examples is that both the general measurement model and the premium allocation approach, they have the same objective, and it is to quantify the total insurance obligations. And the general measurement method is just the default IFRS 17 method. So the default method being the majority part of the standard is written for the general measurement model. And if you are able to meet certain requirements, you then can simplify that to do the premium allocation approach. And the general measurement method and the premium allocation approach, where they differ, where they are different, is primarily for the remaining coverage liability component. And they're very, very similar for the incurred claims component. So that's something just to make clear. And so for the remaining part of this webinar, we'll just be focusing on the remaining coverage portion of the liability. So let's go through the general measurement model mechanics. So again, I'm going to have a few paragraph references over here. And in the very first webinar, I talked about the differences between just initial recognition as a concept and a subsequent measurement as a concept as well. And basically, just in summary, when you issue contracts and you have a group of contracts, you have to have an initial recognition snapshot of what you think it looks like, what you think the quantum of obligations or fulfillments look like initially. And then subsequently, you remeasure that. And so for the general measurement model, there are specific paragraph wordings that says at initial recognition, you look at these components, and we have the components of what we call the fulfillment cash flows. And the reason why it's called that is because you're quantifying what the insurance company has to fulfill on their insurance contracts. And it's constructed of cash flows, all right? So any cash flows ins or outs. And also it has an adjustment to reflect the time value of money. So in the general insurance world, it's basically just taking the present value of those future cash flows, and you allow for a risk adjustment. And for this webinar, just think of this risk adjustment as an additional amount that's embedded within there. So I won't go through the, I guess, the logic and the understanding, the principles of the risk adjustment, but it's just for mechanical purposes, just an additional amount. And then finally, after these three have been determined, we look at an insurance, a contractual service margin, which is supposed to resemble your profit. And so the contractual service margin itself has a separate part within the standard. And it talks about how it looks at the unearned profit. And you can see over here in the second line, midway through, it says it literally specifies unearned profit. And this is, I guess, a very different construct compared to how the general insurance world currently earns things. And so when we determine the contractual service margin, we also have to think about other things. For example, how is this contractual service margin that we have determined initially, how is that going to be released over time? And that is a component that I'll be talking about in one of the examples. So that's initial recognition. We've established the insurance liabilities at initial recognition, including the contractual service margin. Then we move forwards and we're going to have to subsequently measure those liabilities. And so the subsequent measurement of the liabilities, at least for the general measurement model, still looks at the future. It still looks at that fulfillment cash flows into the future. And remember, those fulfillment cash flows are still made up of future cash flows discounted to the present, plus good risk adjustment, still made up of those three components, and a contractual service margin as well. But this contractual service margin will be winding down over time. So eventually, when you reach the end of the expiry of the contract, it'll run down to zero because you've earned all of your profits that you have expected to earn on your insurance contracts. And then, as I was saying before, we also have the liability for incurred claims, which I'm not going to go through in detail in this webinar, but that's part of your entire insurance liabilities, and it relates to claims that have already occurred. Now, with the contractual service margin, there is a part in the standard that specifies how you are supposed to change this from an opening to closing balance. And this is quite prescriptive for the contractual service margin. And if we just take a step back and think about how we're supposed to measure this, well, at the beginning, your contractual service margin is supposed to resemble your profits that you expect to earn throughout the insurance contract. When you sold the insurance contract, you sold it at a point in time under certain economic conditions. And so because of that, you also know that in the future, interest rates would change. And because you've sold it in a set of economic conditions at the very start, then this is just my interpretation, when you lock those interest rates in, that also locks in the environment under which your insurance contract has been sold. And this is one of the features where contractual service margin allows for interest, which is the time value of money, but it allows for the interest accretion at the time or at the time of writing the contract, which is what they call initial recognition. So we start off with the contractual service margin. We need to adjust for an interest component. And then at the same time, if your expectations change about the future, about your contractual service margin, for example, you might have a certain set of expectations for how much you might need to pay out. And 2 years later, that changes because you may have gotten some more claims than you expected or less claims that you expected, and you revise your assumptions. And if that happens to be the case, then you are going to expect a different amount of profit in the future period. And so that's part C of the standard, where it talks about changes in fulfillment cash flows, but relating to future service. If there's a change in cash flows related to current or past service, that goes straight into your P&L. And then finally, the important bit that I want to draw on is part E, which is your contractual service margin needs to be earned. And it needs to be earned because of a transfer of insurance contract services. So as an insurance company, we sell contracts and we have to think about, well, how much service am I providing on these insurance contracts? And if you're providing the same amount of service each period, then maybe you should unwind this profit evenly across your entire insurance coverage period. And service could be, I guess, correlated with things like how much in benefits you have under your insurance policy. It could be the exposure or like the amount that you provide as a sum insured under the policy. So those all could be considered as part of, I guess, these services that the insurance company provides. So let's jump now into the numeric example. And this numerical example is going to use the concepts that we've just talked about, which are these three components here, the CSM, the risk adjustment, the future cash flows. But the only thing that or one of the things that I'm going to simplify is that I'm going to reduce the complexity of this. And one of the things that I'm going to change is that the interest rate is going to be 0%. Now, I'll talk about some of the implications when it isn't 0% at the end. So I'm going to use a 0% interest. And also the risk adjustment will be nil for this exercise. So here are the full assumptions that we're going to go through for the exercise. So we're going to have a 5-year insurance coverage period. So we're selling a policy. It's going to earn out in 5 years. We're going to have uniform coverage units across the insurance period. Now, coverage units is a word in the insurance, in the IFRS 17 standard, but it's not actually a defined term in Appendix A, which is the appendix on the definitions, but it's been used throughout the standard. And coverage units is supposed to resemble the benefits. So you might provide an even amount of coverage units per period. They're supposed to resemble the quantity of benefits that the insurer or the entity is providing to the customer. So we're going to assume that that's uniform. In other words, our expected profit is going to be earning uniformly throughout our entire period. So we're going to take $2,000 of insurance premium paid up front. We're going to have $200 worth of insurance acquisition cash flows paid up front, and we're going to be amortizing according to the incidence of risk. And this incidence of risk is going to be this pattern here, because we expect 240 claims dollars worth of claims to occur in year 1, 320 in year 2, 80 in year 3, 80 in year 4, and 80 in year 5. Total $800 worth of claims. Now, claims are also assumed to be paid immediately once incurred, just to shorten the payout pattern, so we can see the effect on things like CSM and also the profit and loss in the balance sheets as we move through our example. We're going to have policy administration expenses of $25 each year, so 5 years, so 125 worth, and a discount rate, as I was saying, of 0%. So If we think about an example, an illustration of what's happening is worthwhile. So you can see that our claims incurred happens here. 240, 320, 80, 80, 80. We have our premiums of 2,000 and our acquisition cost of 200 upfront. And we have our policy maintenance expenses of $25 each period. And if you kind of like do the ins and outs, we're going to get a total expected profit of $875. And that is our CSM, because we have an expectation that throughout the policy period, if things go to plan, then we're going to be unraveling that the $875 worth of profit over those 5 years. And also because our coverage units are even, we're going to unravel that evenly across those 5 years. So if we think about the balance sheet, and actually before we go on to the balance sheet, if we think about, I guess, how each of our liabilities is going to unwind, and going back to what I was saying in the general measurement model about the fulfillment cash flow. So the liabilities under the general measurement model is supposed to, or are supposed to, represent your future expected claim and expense payments. And so if we're standing at time 0, we're going to be reflecting basically all of the ins and outs on our contract. That's going to be part of our liability. But if we're standing at the end of year 1, just right after we paid these in that year, we're really only looking at the expected cash flows that relate to the 320, the 80, 80, 80, and these $25 worth of payments. And this is something I want you guys to see on the next slide. And so the way this is going to be constructed is I'm going to take you guys through a full balance sheet and a full profit and loss statement. But I won't be spending a significant amount of time on each because it's going to repeat in our subsequent examples. So this balance sheet is obviously a very simplified balance sheet, and there's a few things I just want to draw out. One is that our liability for remaining coverage is made up of components that build within it. And from one of the previous slides, I'll just go to that diagram up here. You can see these are the constructs of our liability for remaining coverage. And if for those who have been exposed to IFRS 17 for a number of years, in the past, it used to be referred to as the building block approach because we have blocks and they build on top of each other. And so in the balance sheet, we have, well, I've set this up this way so you can see the building components within the general measurement model. And within that, we have our CSM, that's the 875 we expect to earn out, determined right at the start, day 1. And we have our policy administration expenses that we expect to pay during each of the years, and our claims, the 800 that we expect to pay during the year. And at the end of each period, we're going to revalue these. We're going to think, do our expectations change? And if we assume that the expectations don't change, then going back to the timeline, all we need to do is to just add, doing a present value if you don't have a 0% discount rate, present value all of the future cash flows, and that would be your claims and your policy administration components of your liability for remaining coverage. And your CSM is going to be unwinding according to things like your interest rate. Remember, we have that interest accretion component, which I haven't put into this example because it does complicate things a bit, but also the unwinding of your CSM according to the amount of service that you're providing to the customer. And that unwinds evenly. So it's a $175 reduction in the CSM balance each period until you go to 0 when you've already completed fulfilling, I guess, the term of the insurance contract. And so your total equity comes through as 875 over here. So the next slide will look at the profit and loss statement, because if we look at both sides, we might get a better appreciation of what's actually happening here. So on the next slide, if we have a think about the revenue and the expenses, they should all kind of like move in I guess, in tandem with the balance sheet. And so first thing to check is that, is the insurance service result correct? The insurance service result, you can think as our profit. If we take the results for each of the 5 years and we add up all of these, we get 875, which makes sense because we expected 875 from the very start. But the most important bit on the general measurement model are these items, which is the insurance revenue. And this is when I want to just take you guys back to one of the blocks. This is why I put one of these in. If we think about these building blocks, these are our liability for remaining coverage. And when we look at these liabilities, as the liabilities go down, this is for the remaining coverage component, we start earning revenue. But the CSM part of the liability earns into revenue according to your coverage units, whereas your risk adjustment and your future claims cash flows, they will earn into revenue according to the incidence of risk or the incidence of your claims incurred, or your expenses incurred. So you could have a few different patterns that could be different from each other of how each one of these components earn into revenue. And your liability for incurred claims, they don't earn into revenue because you've already incurred them, and that the movement in these liabilities only result in a movement in either your cash or movement in your expenses. And so if you end up, for example, reducing your liability, then potentially that means that you've paid out some of the claims. If your liabilities increase for your liability for incurred claims, then you would have to actually book an expense component just to align the two. So let's go back to our example, and then we'll go into, I guess, the change scenario. So as you guys can see, these insurance revenue, it's broken up into your CSM, which is 175 each period, into your insurance services, and these are the sum of your claims you're expected to pay plus our policy administration expenses, because those are components that you've allowed for in your premium. So you should earn them into profit according to your initial expectations, and also your acquisition costs. And when you add all of these up, you get the 2,000, which is your premium, which makes sense. So we're going to now move on to example B, which is the change scenario. And just to keep things simple, the only thing I'm going to change are the claims. So let's just say during year 2, we have actual claims that's higher, $560, which is higher than the 320. And then we revise our assumptions for years 3, 4, and 5. So our actual claims is $240 higher. And when we revise the claims for years 3, 4, and 5, we revise these to be $60 higher than the $80. So now they are $140. So across those 3 years, we're expecting to have 60, 60, 60, which comes together as $180 more claims for those 3 years. And if you add $180 with the actual claims for year 2 being $240 higher, you're going to get $420 altogether. That's going to be a reduction in your profitability. And that $420 we'll see as we look at the P&L in the next few slides. So let's put up a timeline just to reiterate what's actually happening here. So in this timeline, the blue bit represents the increase in claims for that year, but this goes directly into your P&L for that year. When we're looking at the liability for remaining coverage for the general measurement model, it's only the future expectations of cash flows that will impact the liability. So the 560 doesn't actually impact that liability for remaining coverage, but the 140s will, because now we've actually increased our future expectations by $180, which is made up of 60, 60, 60. If we had a discount rate that's not 0%, we'd have to discount those to the end of time 2. And that's going to be used to change our CSM. So changing future inflows, none. Changing future outflows, 180. And for this example, our CSM will be adjusted by $180. So the next slide will show you the CSM component and how this gets adjusted. So we have 875 worth of starting CSM. Then in the first period, all things are normal. And so we take 175 worth of revenue from the CSM, and that closes our balance at 700 CSM. Then at the start of period number 2, we start off with 700, but during that period, we have $180 worth of an expectation change for the future. And so we think that we're going to be worse off by $180. And so therefore, the 700 has to be reduced by $180 because we're saying, well, hang on, we don't have as much CSM left to earn out in the future. Let's reduce it by $180. And then that final next balance is 700 minus the 180. That final result is then used to earn out across the next few periods, also evenly, which is why you're seeing a reduced 130, 130, 130, 130 balance. And so the lower CSM revenue is earned for each subsequent year, but only starting from that year 2, which is this darker shade of blue. So the question is, and you guys don't need to answer the question, I'll answer it for you, but the question to think about is, well, what happens if the change in fulfillment cash flows, rather than changing by 180 worse off, it's over 700 worse off? Well, that's when you actually don't have enough profit, expected profit, to absorb your changes. And for each dollar above that, you're going to actually run into onerous losses. And this is, I guess, where I just mentioned it briefly. And onerous losses occur when your CSM for directly issued contracts runs below 0. And to the extent it runs below 0, you're going to recognize that as an onerous loss expense. There are some I guess, little bits that you have to be careful of with the discount rates. You have to use, if you're using a non-zero discount rate, which is everyone, if you're using a non-zero discount rate, it has to be those discount rates determined at the inception of the contract. And for the same reason, where we had a set of environments that we've wrote this contract in. So when we're adjusting the CSM, we should use those same set of environments for the interest rates to adjust the CSM as well. So let's go to the balance sheet, and then we're going to visit the profit and loss, and then I'll summarize the general measurement model, and then we'll move on to the premium allocation approach. So the general measurement model balance sheet now for period number 2, it changes because we have a lower CSM. Now it's 390. It's no longer reducing by 175 each period. It took a larger hit down for period number 2, and then it reduces by 130 each period. Our claims are going to be higher because instead of paying out, expecting to pay out $80 each period, we expect to pay out $60 more each period. And so these liabilities are going to be higher, but our policy administration component of our liability for remaining coverage is unaffected because we haven't revised that expectation. And you kind of like just put it together and ins and outs, and you get your total equity. So the equity in year 2 is reduced by 285 to 65. And it's because of our actual versus expected claims. So the actual claims were $240 higher than the expected claims, but our CSM revenue is $45 lower because we originally thought that we could earn $175 worth of revenue, but now we're only earning $130 worth of revenue. So the difference is basically a deficit of revenue that we could have earned if these expectations did not change. And so you put them all together, and so our 65 is 285 lower than our example A balance sheet at time 2. So now let's look at the profit and loss statement. So our profit and loss statement is unchanged for period 1, but as you guys can see under period 2, we now have a loss, right? So this could be a profitable contract, and in this example, it's still a profitable contract, but we have a loss for that period. And the main reason is because our claims have just surged up so high to 560. And so we didn't allow for as much of a CSM revenue. That revenue needs to be distributed over our future insurance period according to our coverage unit pattern. And so we're going to have a loss for that period, but then we're going to earn our profits out according to the CSM pattern if things don't change again. Okay, so the total insurance service result is now 455. That's the sum of that bottom row, 455. And if you think about when I went through the example change, we had the actual versus expected claims increase of 240 and our future expected claims increase of 180. You put those two together, and that makes up the 420. And so our total profit is 420 lower than example number A. So now our total profit is going to be 455. So in summary, for the general measurement model for these two examples, the liability for remaining coverage is based on the present value of future cash flows. It's a prospective method. In our example, we didn't use a interest rate, but just knowing when you're applying these in real life, we have to do a present value discounting. This is just to show you guys, I guess, the ins and outs and mechanically how it applies. The initial recognition CSM is the initial expected profit. And the changes in your future expectations, they must be reflected in your liability for remaining coverage. And if they're too large to be absorbed by that CSM, that $700 example that I asked you guys about, then you're going to incur an onerous loss expense. And finally, if your discount rate is not 0%, you're going to have additional line items. So I would have had to include additional rows for things like insurance, finance, income, and expense. I had to basically unwind things in a different way and explain more reconciliations. That could potentially be something we can talk about in the future or present in the future, but at least for this first one, I didn't want to overcomplicate things. So let's move on to the next bit, which is the PAA mechanics. So I'm going to go through the same examples and also show you some extracts from the standard, and then we'll kind of like put these together under the PAA eligibility topic. So under the premium allocation approach, it's going to be looking at, again, an initial recognition snapshot, but the snapshot looks at things differently. It's more of a retrospective approach. And why do I say that? Well, if you look here on initial recognition, this is when you're setting it up. If you have received any premiums or paid any acquisition cash flows or earned any premiums or acquisition cash flows, which is not too likely at initial recognition because you're at the very start of the contract, then that's only when you affect the liability. And in subsequent measurement, when we look at the premium allocation approach, we look at what the previous liability for remaining coverage is, and we only adjust that according to basically things that have happened. So either premiums you've received, acquisition costs you have paid, you're looking at amortizations of acquisition costs, or recognition of insurance revenue, which is the premium earning that has already happened. Right? None of this talks about, I guess, claims you expect to pay in the future. And probably the only component that looks to the future would be your premiums you expect to receive in the future, because those are actually used in the amount that you can recognize as insurance revenue for services provided in that period. So that you can see that while the general measurement model for the liability for remaining coverage is more forward-looking, the premium allocation approach is utilizing more events that have happened before. And from general insurance terms, the liability for remaining coverage under the premium allocation approach is more analogous to the current liability adequacy test, or the AASB 1023 method of calculating your premiums liability, whereas the general measurement model is more analogous to the actuarial premiums liability way of calculating things. So liability for incurred claims, I just want to mention that the premium allocation approach, the liability for incurred claims is very similar to the general measurement model, but there are some things that are a little bit different. So for example, you may not have to reflect the time value of money if you have a short payout period. Okay, so there's not that many differences between each. And a common misunderstanding is that the liability for incurred claims, when you get to that section of the liability, you need to use the general measurement model. But that's not the case. It's when you get to the liability for incurred claims, if you're using the premium allocation approach, you're still using the premium allocation approach because it has its own section that tells you how to calculate that liability. And it's only for the future claims component where you have the biggest discrepancy. And now I just want to talk about briefly the revenue earnings for the premium allocation approach, because that's going to be used in our example. Under the general measurement model, as you guys saw those building blocks, the liability for remaining coverage earned into revenue according to things like the CSM pattern and also your claims payout pattern that you expect in the future. That's how your liability for remaining coverage earns into revenue. But under the premium allocation approach, the standard really has kind of like two components that impact the revenue earning. You can either earn it according to the basis of the passage of time, basically just even, because time occurs, I guess, goes through evenly, or we'd hope. And also, if we don't think that that's appropriate, so for example, if we think that our incidence of risk is going to differ significantly, then we're going to be earning on the basis of the expected timing of that. And the standard doesn't give you, I guess a level, a threshold to say, okay, if you're above this threshold, then it's significantly different. It just says if it differs significantly. So I guess a lot of judgment will need to be used there. But you have that as as an option if you believe so. So in our example that we're going to look at, that same example, we're going to be using part B. We're going to be earning the premiums according to, not to the passage of time, but according to the expected timing of the insurance service expenses, which is our incidence of risk. So as you guys can see diagrammatically, liability for remaining coverage, it looks at things that have happened in the past. Premiums received, acquisition costs paid, premiums earned, acquisition costs earned, we get our liability. And our liability for incurred claims, if you guys compare this slide to the other illustration of the general measurement model, it's basically identical. I've just grayed out the discounting part at the bottom because you may not have to discount according to the how long your payout patterns are. So now let's look at our example again. You can see the same assumptions. However, I've removed the line that refers to coverage units because coverage units don't apply to the premium allocation approach. And then I've also added in a line that says the premium earned according to the expected pattern of release of risk, which is our incidence of risk pattern. So now let's go on to the balance sheet and the profit and loss statement under the premium allocation approach. All of the other numbers are the same here. So for the balance sheet under the premium allocation approach, you can see it looks a little bit different. We don't have the components that's built up for our liability for remaining coverage that we've seen in our general measurement model. But what we see is a line called carrying amount of liability for remaining coverage. And again, this is a section of the standard that tells you how you need to change your liabilities for the premium allocation approach. So we start off with what we've had in the previous period. And we look at how much we've either amortized worth of acquisition costs or how much we've recognized in terms of revenue. And through our claims pattern, if we use the pattern of where we expect to pay out the claims, we earn our revenue in that same pattern, and that produces a revenue recognition pattern of 600, 800, 200, 200, 200 over there. That gets used to reduce the liabilities every time we recognize the revenue. And from an intuitive standpoint, basically what that is you can think about it as, well, if you're recognizing your revenue, you're basically saying, hey, I've fulfilled some obligations, therefore I'm going to recognize some revenue, therefore I'm not as liable to pay you that component. My obligations as an insurer has reduced, and that's the only reason why I'm earning the revenue. And that's why earning revenue reduces the premium allocation approach liability for remaining coverage. So let's look at the profit and loss statement. So the profit and loss statement over here, we have the allocation worth of our expected premium receipts and also our pattern of incidence of risk. So that's that top row. So they add up to 2,000. And what you should also see is that it's much lower in periods 3, 4, 5 because we expected less claims to be incurred in periods 3, 4, 5. We expected the most claims to be incurred in period 2, which is why it's higher in period number 2. Our expenses are our expenses. Our claims expenses are basically when our claims are incurred. Our policy maintenance expenses and our acquisition expenses are basically when we amortize our acquisition costs and also our policy maintenance expenses. And these are basically the same as the general measurement model because that's when we are expensing our actual true costs. It's only the revenue recognition pattern that has a significant difference. If we look at our total insurance service result, they're basically the same. They are the same when we look at the aggregate. 875 is no different to that under the general measurement model. But you can see that rather than having an even 175, 175 according to that CSM, we are earning a lot more in the first 2 periods because we expect more claims to be incurred in the first 2 periods, and therefore a higher revenue is going to be earned in the first 2 periods. So the pattern in which we earn our revenues and hence recognize our profit is going to be different between the 2 methods, but the total profit is going to stay the same. So let's look at what happens when we change the assumptions. So we're going to shock the assumptions. So exactly the same. but we're going to increase our claims by 240 in period number 2. And then we're revising our claims for periods 3, 4, 5. Same sort of scenario B as the general measurement model. So let's see what happens. Well, in our balance sheet, there's actually no change in our liability for remaining coverage closing balances. And why is that? Well, if you think about it, we're changing our expectations of the future. Well, have we changed our premium earning pattern? No. Have we changed our amortization of our insurance acquisition cash flows? No. Are we changing the pattern in which we're receiving or paying out insurance acquisition cash flows? No, because the payments have already occurred at the inception. So there's nothing in there that's going to change the liability for remaining coverage under the premium allocation approach. There's no CSM, there's no coverage units. It doesn't refer to the future cash flows at all. So therefore, those liabilities, these will be exactly the same. And our cash would basically be changed according to how much we are paying or receiving. And this is going to be it's changed according to example A, but it's going to be the same set of cash and cash equivalents as the general measurement model because it's the same numbers that are actually coming in and out. And so let's look at the profit and loss statement now. So under the profit and loss statement, you can already see that under period number 2, which is what I've highlighted, we used to have the highest profit in period number 2, but now that's lower, a lot lower. But it's still not a loss. It's not a loss because we've earned more revenue according to our incidence of risk under period number 2. The amount that we earn as profit in periods 3, 4, and 5 are also lower. And the total insurance service result is 455. It's the same as our general measurement model, example B, but the recognition pattern is different. And so when you put that all together, that's something kind of, I guess, on the profit and loss statement to also be mindful of in conjunction with what's happening on the liability balance sheet side. So what are the key takeaways for the premium allocation approach mechanics? Well, it's based on, I guess, a retrospective method for the most part on the cash flows on the premiums and acquisition costs that have actually occurred and also, or expected to occur, and also the amortization schedule. And when I say expected to occur, that's only used for the amortization part, not the expected cash flows part, like the general measurement model. It's intended to be a simplification of the liability for remaining coverage on the general measurement model. So it's not intended to be the default. It's just basically saying that if this kind of like closely resembles the, I guess, the outcomes on the general measurement model, then maybe you can use it as a simplification. And in the next part, we'll kind of like look at that in a little bit more detail. And the changes in future expectations, it impacts that to a much lesser degree. So things, one of the few things that could affect it would be if you change your earning patterns, right? And one of the paragraph references when we looked at the passage of time earning pattern or the incidence of risk earning pattern, there was actually a line underneath that says, well, if you think that your patterns could change, you need to reflect that. So that could be a situation where your liability for remaining coverage pattern that it unwinds in would change. And adjustments for time value of money are very limited. And finally, the liability for incurred claim mechanics are very similar to the general measurement model incurred claims mechanics, with just some additional optionalities allowed for discount. So now for the final part, we're going to look at PAA eligibility. And I'll just kind of like go through what the standard references are, and it's just one slide for those references. And then I'll look at some, I guess, how we can quantify those same 2 examples that we've looked at above, and how we can actually think about this approach. And I'm not going to conclude any results for this. I'm just going to give some pointers and some ideas that you guys can think about. So the premium allocation approach has a section under the standard that says that you are allowed to use it under certain conditions. And part B looks of this paragraph 53 says that one of the conditions is that if basically in short, if your coverage period is 1 year or less for all of your contracts, then happy days, you are allowed to use it. You don't have to do anything else. But if it's not, then to be faithful to the simplification concept, if it generates a result that's not too different from the general measurement model, then maybe that can be still okay, right? So we're still trying to report our results. And if our results using the premium allocation approach is not going to give us too different of a result, and when I talk about result, I mean the liability for remaining coverage. If that result is not too different from the general measurement model, then maybe that could be an okay reason to use the premium allocation approach. And that result, it needs to have a couple of considerations. One is that if you say forecast your cash flows or your liabilities, the differences aren't too big, but also that we all know assumptions might change. And if we think that the assumptions may be exposed to some significant changes that could throw off this simplified approach to be closely resembling the general measurement model, then under those circumstances, maybe it's not too close after all. Maybe it's close in some scenarios, but in other reasonable scenarios, maybe it's not close, maybe it's extremely different. So that needs to be considered as well. And again, there's no specific guidance on the specific threshold here. So how do we put all of this together? Well, in the next slide after this one, I have a few, mathematical examples or mathematical formulas that I've put together where these are just some ideas of what you guys can do to quantify these. And when we look at this, we need to think about the liability for remaining coverage. And again, we're not looking at the incurred claim, we're not looking at the profit and loss, we're looking at the liability for the remaining coverage portion. And so the visual diagram is used to easily explain the bit that we're looking at. So the graph, one color relates to the general measurement model, liability for remaining coverage, that's the darker color. The lighter color is the premium allocation approach liability. And when the bars are different, it means that there's a difference, right? The left graph is the example A, liability for remaining coverage, those balance sheet examples that we've looked at. Example B is that change scenario. This yellow bit here is the impact. And as we talked about, there's no impact on the premium allocation approach for this example, but on the general measurement model, our discrepancies have increased. So this would actually make it less likely that we'll be eligible for the premium allocation approach. So now let's look at some numbers now, because this is kind of like a visual diagram to show you what we're looking at. And then let's look at some numbers to try and see what does it actually mean. So what I've done is I've pulled together just the liability for remaining coverage from each of those examples above. So I went through each of the balance sheets. So there are 4 balance sheets in total, 2 for example A and 2 for example B, and 1 for general measurement model and 1 for premium allocation approach. Put all of these in front, and we're going to look at the difference. But everyone can have a different view on what defer materially means, right? So I could say it's very different, but someone else could say, well, actually, if you have this other perspective, they're actually not that far different. So it seems like there's a lot of judgment that needs to be applied. And whenever you have some judgment applied, one thing that we can borrow from the field of statistics is that let's try and quantify something, right? If we're talking about differences, let's try to quantify that. I mean, one way to quantify these differences is take a difference, right? We take a difference and then we realize, well, doesn't matter if it's a negative difference or a positive difference. Maybe we just take the absolute value of the difference, just the value of the difference. So that's one idea. But in statistics, there are other ideas as possible as well. And you guys, for those of you guys who have done statistics or remember statistics, there are some terms called your mean squared error. And those absolute values that I refer to are your absolute errors. In statistic, error means kind of like the difference terms. And so in the next slide, which would be the most technical slide of this presentation, I've just put together some 9 different ways that some of them I've seen, some of them I haven't seen, that kind of like just my ideas that I'm just floating out, that you guys could consider in quantifying this difference, right? So remember, the objective is to quantify the differences between the two. And so here are the 9 different measures. And I do know that this quite technical here, so I'm not going to go through, I guess, all of the mathematics. The reason I put the mathematics in is because it's easier just to, rather than explaining with words, the mathematics just basically explains it for itself. And then I'll just kind of like put a little bit of a flavor on the side. So with these 9 measures, we're trying to quantify these differences. Measures 1, 2, and 3 are looking at that absolute value of the differences, but it comes through in kind of like a few different ways. One way is we just take the absolute difference for all of the periods. So for example, we calculate the difference, take the absolute value, and we add all of them up. For number 2, we might average it over the number of periods. We might want to look at the average difference per period. For number 3, maybe the average difference, we're averaging over periods that aren't that relevant. Maybe it's at the end of the contract, potentially. So potentially we might add some weights. Maybe we'll say that, oh, actually, we want to take the difference, take the absolute value, but maybe we assign more weights to these periods because we think they should be more of an importance in our considerations. Okay, now how you determine the weights, I haven't given you guys any ideas on that, but that could be like that method itself could be a structure that you could consider. Methods 4, 5, and 6 are where I talk about the mean squared error or the mean squared difference. Basically, what it's saying is we're going to take the difference, but rather than taking the absolute value, we're going to square it. And you might think, well, why do you want to square it? And you want to square it because the bigger the difference, by squaring it, you're actually putting more of an emphasis on that difference. So if you think about 2 squared is 4, but if you have 10 squared is 100, right? And 4 is 2 more than the number 2, but if you square 10, 100 is 90 more than the 10. So by squaring measures, you're actually placing more emphasis, or you're becoming more sensitive for any discrepancy that's bigger from the norm. And then 7, 8, and 9 are looking at, rather than trying to aggregate all of your discrepancies together in kind of like one measure, it's looking at each period. So for example, you might just be looking at the absolute difference each period. You might be looking at the absolute difference by expressing it as a percentage of some liability and looking at that per period, but you're not aggregating them up, you're just looking at them or eyeballing. And the final one, maybe you take a percentage of GWP. So when we put them all together, this is kind of like what we see, and we have the same liabilities. I've made up some weights. These are completely made up. So 40% only because maybe we believe that the 40% weights are more attributable to the first 2 periods where it's more important. And then we calculate each of these different measures. So we have measures 1 to 9. And what I want you guys to see is that the measures 2, 3, 5, and 6, they come up with numbers not too far different. And noting for the fact that these numbers just resemble discrepancies, all right, dollar discrepancies, and you still need to compare that to something. Okay, so I'm just going to show you example B, and then I'll talk about, I guess, what next. So in example B, what I want you guys to see is that because we had that increase in our claims, and as you saw from one of the graphs where we looked at those yellow bits on the general measurement model that were higher in example B, we're going to get larger discrepancies, which is what we're seeing here. Now, examples 3, 2, 3, 5, and 6, they've all increased. They've all increased by 12 to 14%. But measure 4, when we're actually squaring the difference without taking the square root, is going to be increased by 30%. So you can see that's more sensitive. And partially where it comes from is when we do the assumption change, that absolute difference is 345 in our liabilities. And when you square that, you're getting 119,000. Now, the values itself don't matter too much, but it's what you compare it to that could matter. Okay, and it's more of the relativities that could be more of the importance. So what are the key takeaways for the eligibility? Well, if you have coverage periods on under 1 year, all good, you can be eligible. It doesn't mean you have to apply it, but you can apply if you want. If you have coverage periods over 1 year, then it depends on the expected differences. And ideally, you want to model those differences. And there are many methods available to quantify the differences. I've just given you guys 9. There could be a lot more, right? You could look at the changes in any one of the 9. And maybe the changes are the ones that indicate whether or not something is exposed to volatility. So that could be an idea as well. But whichever method is selected, you should, in my opinion, you should have some sort of a threshold, right? So if you think about in statistical testing, you have a hypothesis test, but you never want to test that threshold in hindsight. You want to try and kind of like set it before you do the test. Otherwise, there could be that biased nature. So you want to think of some threshold where you can test at that threshold, a pre-agreed threshold, and then do the testing, come up with results, and kind of like compare it to that threshold. And finally, modeling should be done at the inception of the group of contracts. So what next? So I guess in conclusion, there are a few things to think about here. As you guys can see, there are a few different components in the general measurement model, and the components under the premium allocation approach is slightly different, or quite different for the liability for remaining coverage. Which set of reporting and disclosures are you more comfortable with? And I haven't gone through the disclosures, but they are different. Now, do you have the right resources? So are your systems streamlined? Do they have the right data granularity to be able to produce those components under the general measurement model? Are you able to do the testing for PAA eligibility? So do you have the, do you have the resources, and do you have the capability or the models to do the testing? And are you aware of the potential differences in revenue? This is more of like a business planning executive kind of a thing to think about, which is when you have these profit signatures, which are different, is management aware of that? So for example, in our two examples, these numbers you've already seen, we know that under PAA, we've earned more revenue under periods 1 and 2 because of the incidence of risk. But what that also means is when we have changes under our general measurement model, we're going to make a loss in period 2 because we're earning less revenue under the CSM. But under the premium allocation approach, we could be okay, right? So there are these factors in profits that could you might need to take into consideration. This is more of a communication piece to allow your senior leaders to be aware of that. And the closing remarks, final slide, is that IFRS 17 is a complex accounting standards. And there's many interrelated parts. Like I haven't even included a discount rate that's not 0. There could be a lot more complexities involved. And statutory disclosures are actually the results of applying theory. And I've heard in a few instances that, oh, this is just theory, don't think too much about the theory. But if you kind of like have a think about it, the only reason why we have satellites orbiting the Earth is because someone has applied theory to get the satellites up there. And once they get it right, it orbits the Earth. So we need to first understand what the theoretical understanding of IFRS 17 is and what it means. And then we apply them in some illustrative examples. And so understanding that also allows us to communicate why things have changed to senior stakeholders. It'll be a little bit embarrassing when we have investors after we announce to the market asking us, why has this value changed from X to Y? And we can't explain it. So understanding theory is important, but also having the mindset that this understanding is used for the practice. Having more automation is definitely needed for IFRS 17 because of all those parts. And the industry is likely to develop new metrics over the coming years. So things like maybe CSM percentages, maybe the insurance service result as a percentage of another measure. So these things are still going to be, I guess, developed over the course of the next few years. And with that, I'm conscious that we've gone over time. I would like to, for those of you who are still here, I would like to open it up for questions.
Yeah, thank you, Owen. Once again, I think, as I mentioned last time, you've got a great knack for distilling the complex. So really appreciate that. There's a couple of questions in the chat if you do still have a couple of minutes to answer them. So the first question we've got is, what is the entry in the books for the change in the FCF?
That won't be a kind of like a one-line answer because it depends on, I guess, the component changes. As you guys have seen, the FCF, which is the fulfillment cash flows, has a number of components. And so you need to unpack each one of those components before you do the bookings. So that'll be my answer for that one.
For today. And the second question we've got come through is, where does the liability for incurred claims come into the example of the general measurement model? And because the example only shows the change in the CSM and the movement of the LfRC.
Yeah, good question. So the examples that I've come up with, they focus only on the liability for remaining coverage. And I guess one of the other good reasons is because the liability for incurred claims, at least from the general insurance perspective, is more or less very similar to what's being done right now. Where in actuarial reserving for general insurance companies, we take the present value of future cash flows, which is really the liability for incurred claims, or very close in concept to. So that's why I've kind of like left that out of the example.
Sorry, is there another question that's come through?
Yeah, one
Oh yeah,
about
about recording. Yeah. So yeah, the recording should be available on the website, and the slides will also be available on Owen's website. So I think Di's actually just popped up the link.
Yeah.
The link now.
Yeah, the slides will be available shortly, not too long after this session.
And will there be another session for VFA?
At the moment, there's no intention to do the VFA, and I guess I always align to, I guess, what I'm able or what my company is specialized in is mainly for general insurance. But in the future, if we do have additional resources or to, I guess, tackle the VFA, there could be an opportunity for that, but there's none of that in the horizon as we speak.
I was going to bring it to an end, but we've got another one if you do have a moment, Owen. Where do you see the FSL income and the FSL expense? Do you see it as part of liability for remaining coverage?
So the FSL is the financial service.
Levy.
Oh, sorry. I was thinking of financial income, service income and expense. I guess you have to think about whether it's a, I guess, first of all, what method you're using, and also if it's a future cash flow related to future service. That all takes part in that. And I think the FSL, if you're talking about the FSL levy, if it relates to future service, then it will impact. And also if you're using the general measurement model, then it will impact the liability for remaining coverage. So you can see there are a few things that we need to boil down before we actually figure out which one it impacts. But in general, for the general measurement model, future things happen, future, I guess, exposures for your risk, that they go to impact your liability for remaining coverage.
Okay. I think yeah, apologies, we've gone a little bit over, but it's I'm sure, Owen, you could speak all day on this. But yeah, thank you so much for once again coming and presenting this to us today. Really appreciate your time, and thank you to everyone who joined. And I hope you enjoy the rest of the day.
And I'll just probably just say I do appreciate that I've gone a little bit faster than I intended. I was a bit ambitious in putting these slides together. Probably 1.5 hours might have been a little bit better. But given that it is recorded and you guys will see the slides, you can replay the webinar. If it still doesn't make sense for the slides, you can reach out on my website. There's a contact us, and I'm happy to explain things in a great amount of detail.
Thanks again, Owen. Bye.
Thanks, guys.